Right now, thousands of Australian pensioners are about to get a nasty surprise in their bank account, and most of them have no idea it's coming. Concerned, because here's the truth: nobody tells you clearly enough. The moment your savings go up, even by a small amount, Centrelink may already be recalculating your pension behind the scenes. And with new thresholds that just came into effect on the 1st of July 2026, the rules have shifted again. Reassuring. Some of you will actually end up better off. Others could see your payment drop without warning. So today we're going to walk through exactly what happens if your savings increase, whether you could lose part or all of your age pension, and what you can do right now to protect yourself. I'm going to keep this simple, no jargon, no confusing spreadsheets. Warmly, just plain, honest explanations, the way I'd explain it to my own parents over a cup of tea. If you're new here, welcome to Centrelink Pension Bulletin, where every week we break down exactly what's changing with your pension in plain English so you're never caught off guard. Let's start with the big question everyone asks. Does more savings automatically mean less pension? The answer is it depends. And that little word depends is exactly why so many pensioners get confused. Centrelink doesn't just look at your income, it also looks at what you own. This is called the assets test. Your savings account, term deposits, shares, and even money sitting in an account-based pension all count as assets. Your home, if you own it, generally does not count. Here's where it gets interesting and where a lot of people trip up. Centrelink runs two separate tests on your situation, the income test and the assets test. Then it pays you based on whichever test gives you the lower pension amount. So even if your savings are still under the assets test limit, they might already be affecting you through something called Deeming, which we'll get to in just a moment. Stick with me because this next part surprises almost everyone I explain it to. Let's talk about the actual numbers updated as of the 1st of July 2026. For a single homeowner, once your total assessable assets go above roughly $320,000, your pension starts to reduce. Once those assets reach around $720,000, your pension cuts out completely. For a homeowner couple, the pension is reduced once combined assets pass a certain point, and it cuts off entirely once you reach around $1,085,000 combined. If you don't own your home, those cutoff points are higher because Centrelink assumes you need more savings to cover rent or future housing costs. For a non-homeowner couple, the cutoff sits at around $1,343,000. Now, here's the part that really catches people out, and I want you to really pay attention to this one. It's not just about crossing a big threshold. Even a small increase in your savings, say from an inheritance, a redundancy payout, or simply selling an old car, can nudge you from a full pension into a part pension. And once you're in part pension territory, every extra $1,000 you hold can shave a little more off your fortnightly payment. So the real question isn't just how much can I have? It's how does Centrelink actually calculate the reduction? And that's where deeming comes in. So let's break that down properly. Deeming is one of those Centrelink words that sounds complicated, but is actually a fairly simple idea once you see it in action. Centrelink doesn't ask you how much interest your bank account actually earns. Instead, it assumes or deems that your financial assets are earning a set rate of return, whether they actually are or not. As of the current rules, the lower deeming rate is 1.25%, and the higher deeming rate is 3.25%. For singles, the first $64,200 of your financial assets is deemed at the lower rate. Anything above that is deemed at the higher rate. For couples, that lower threshold combined sits at $110,600. So let's say you're single and you have $500,000 sitting across your savings accounts and term deposits. Centrelink doesn't care that your actual bank interest might be higher or lower than this. It assumes a deemed income, and that deemed amount is what counts toward your income test. Here's why this matters so much right now. Because the threshold just went up on the 1st of July, a slightly larger portion of your savings is now deemed at that lower, gentler rate. In plain English, that's actually good news for many of you. It means your deemed income might be a touch lower than before, which could gently increase your part pension. But don't get too comfortable yet, because I want you to hear the next part carefully. This is where things can quietly work against you if you're not paying attention. If your savings increase enough to push you well above that lower deeming threshold, more and more of your money gets deemed at the higher 3.25% rate, and that flows straight into the income test, potentially reducing your pension. So the size of the increase matters just as much as the fact that your savings went up at all. Now let's talk about something a lot of you have asked me about directly in the comments. What if you receive a lump sum, an inheritance, a downsizing payment, or money from selling a property? The moment that money lands in your account, it becomes an assessable asset. There's no grace period where Centrelink simply ignores it. However, there is one important exception worth knowing about. If you sell your home and plan to buy another one, the proceeds can be exempt from the assets test for up to 24 months, and in some cases extended to 36 months. During that time, the money is still deemed, but only at the lower rate. This is a genuinely useful protection if you're between homes. So if this applies to you, it's worth having a proper conversation with Centrelink or a financial advisor about how to structure it. Now, here's a curly question I get asked constantly. Can you simply give your money away to avoid the assets test? Centrelink calls this gifting. And yes, there are rules around it, and they're stricter than most people expect. You're allowed to gift up to $10,000 in a single financial year, with a maximum of $30,000 over 5 rolling years. Anything above that is still counted as an assessable asset for 5 years, even though you no longer physically have the money. So no, quietly transferring savings to your children the month before you apply for the pension is not a loophole. Centrelink has seen that move before, and the rules are built specifically to catch it. Let's shift gears now, because I promised you some genuinely good news too, and here it is. If you're still doing a little paid work in retirement, there's something called the work bonus, and it's more generous than a lot of pensioners realize. Under the current rules, you can earn up to $300 per fortnight from work without it affecting your income test at all. And if you don't use the full amount in a given fortnight, it accumulates into a buffer up to a maximum of $11,800. This means some pensioners can actually take on some casual work or a small business venture, receive income, and still keep their full pension untouched simply because the work bonus absorbs it. If you're one of the many retirees doing a bit of consulting, gardening work, or casual shifts to stay active and social, this is worth checking carefully, because you may be leaving money on the table without realizing it. All right, let's bring this back to the core question we started with. What actually happens step by step if your savings increase? First, Centrelink will usually become aware of the change either because you report it or through their regular data matching with banks and financial institutions. Second, your assets are reassessed against the current threshold for your situation, whether you're single, partnered, a homeowner, or not. Third, your financial assets are deemed under the current rates we discussed, and that deemed amount feeds into your income test. Fourth, Centrelink compares the result of both tests, the income test and the assets test, and pays you based on whichever produces the lower pension amount. And finally, if your assets have grown enough to push you past the relevant threshold, your fortnightly payment is reduced gradually, not cut off in one dramatic jump, unless you go well beyond the upper cutoff point entirely.
This is exactly why staying on top of these numbers matters so much, especially as thresholds shift every March, July, and September. A change that helps you today might work differently again in just a few months. So, what should you actually do if your savings have increased or you're expecting a lump sum soon? The first step is simple. Report the change to Centrelink as soon as it happens, through your MyGov account or by visiting a Services Australia office. Don't wait for the annual review, because underreporting can lead to a debt you'll have to repay later, and that's a headache none of us need. The second step is to actually run the numbers before the money arrives if you can. A financial counsellor or a Centrelink Financial Information Service advisor, which is completely free by the way, can model exactly how a lump sum will affect your specific pension. And the third step, which so many people skip, is to check whether restructuring how you hold the money could help. For example, using some of it toward home improvements, which don't count as assessable assets, might be worth exploring with proper advice. I know all of this can feel like a lot to take in, especially when the rules seem to shift every few months, but that's exactly why I make these videos every week, so you don't have to dig through confusing government pages just to understand what's happening with your own money. If today's video helped clear things up even a little, do me a favor and hit that like button. It genuinely helps this channel reach more people just like you who are trying to make sense of these changes. And if you haven't already, subscribe to Centrelink Pension Bulletin, because next week we're breaking down another major change that could affect how much you receive. And trust me, you'll want to see it before it takes effect. Drop a comment below and let me know your biggest question about the assets test. I read every single one, and I often turn your questions into future videos. Thank you so much for spending this time with me today. Take care of yourselves, look after your savings wisely, and I'll see you in the next one.